Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, so we're going to talk about investors buying homes, and we actually have some specific numbers.
Okay.
We're also going to talk about the hedge funds because there's some interesting stuff going on with them.
Right. So if you like data, if you like interesting real estate discussions, please make sure that you subscribe and hit the notification bell and like the video.
And if you do subscribe, just leave us a comment and tell us that you subscribed.
Yeah, and then tell us where you're watching from. You know, we have people watching from all over the world, and so we're always interested to find out where you're from.
Yeah, it's what's funny is we have people reach out to us from Singapore, Hong Kong, places like that because they have investment properties here, and they're just trying to figure out what's going on in the market. Okay, so the headline of the article, there's actually two articles we're going to talk about. The first one we're going to talk about, investors bought a quarter of homes sold last year, driving up rents. Okay, so this, when it says last year, it was 2021. They still were buying in 2022. Now, what was interesting about the number, as we went through the article, was we were able to get the number for Nevada. Okay, 5 states saw the highest share of investor purchases. Investors bought a third of single-family homes in Georgia, Arizona, Nevada, California, and Texas. The highest was Georgia, a third, but Nevada was 30%.
So what I thought was interesting was that headline that investors purchasing homes is the reason why rental rates went up. So leave us in the comments the reason why you think that an investor purchasing a home would drive rents up as opposed to the existing rental market and the incremental rent increases that are customary.
And maybe at the end we'll sort of, because we are going to talk about the investors a bit because there was more data on that.
Yes.
Okay, so 30% Nevada. What that means now historically, 15%. So if we go back to 2012, from 2012 to 2020, investors of all types were 15% of all purchases. So like call it 1 in 8. But now it's like, it's double that.
Right.
And in some areas, it's a third. Okay. What we're going to do is we're going to show a chart here that shows the whole U.S. And we'll talk about it a little bit. So where you see dark blue at the end is 33%. Where you see it really light was 10%. Now, the baseline is 10% because that was the lowest in any state were 10% investors and 33%. Okay, so first of all, Juana, let's talk about the typical investor versus what are some characteristics of an investor from a financing perspective versus a person who's buying their first house they're going to live in.
So investors tend to either purchase cash or put a lot of money down. Loan programs are not investor friendly, so most of them demand at least 30% down, if not more. So that's why investors tend to have a lot of equity in the property. Now, what I find interesting about that is that the more money you put down, the less of a mortgage payment you have, so the more flexibility you have in the amount of rent that you charge. Okay. So this kind of circles back to the beginning where it said, hey, investors are what drove up rental rates, which again, tell me how. Because using this theory that investors either buy cash or they have to put more money down, which makes the property cash flow better, what would cause them to charge more than somebody who already owned investment property? And then the second portion of that is, tell me about the market. Tell me about the rental market. So if there are 2 rental houses that are the same in every way, they're side by side, one is owned by this investor that purchased it in 2021, and one is owned by somebody who purchased it the year before. One is, let's say, $2,000 a month, and one is, let's say, $2,300 a month. Which one are you going to rent, providing that the houses are identical? My logic says that I would rent the one that's $2,000 a month, not the one that's $2,300. So how is it that the $2,300 gets any takers at that level versus having to reduce the price to market rate?
Right. The other thing too that, especially the institutional investors, a lot of them are parking cash. They see the returns. They see real estate is long-term an extremely safe bet. It's probably one of the most safest bets for parking cash that still gives you a high return.
Right. So real estate is not only safe because it's a tangible asset, but it also has predictable returns. I think this is one of the really key factors about real estate is that it's a tangible asset with predictable returns. There are lots of tangible assets, but this one has such a long track record. I mean, several thousand years of people owning real estate, right? And certainly in particular markets, there's a long track record for what the return on that investment is.
Right. And the predictable return mostly comes in form of rent.
So it comes in two forms. It comes in the form of rent.
Right.
It also comes in the form of appreciation.
When you sell it.
When you sell it. Now, it also comes in the form of tax benefits.
Oh, let's talk about those real quick. Short, 30 seconds.
Yeah, so tax benefits are something to consider when you're an investor as well.
Okay. Now, what is interesting is when you look at these states, the top states are Georgia, Nevada, Arizona, Texas, California, North Carolina, Tennessee, Mississippi, Idaho, and then the rest of the states not so much. Mm-hmm. So what's significant about those states versus other states?
So what surprised me is that those states are a mixed bag as far as income tax, as far as state income tax.
So Texas, Nevada, none. Tennessee, none.
Right. But
the rest have taxes.
The rest have taxes. So particularly California, and California we all like to make fun of, but they do have substantial state income tax. They have all kinds of restrictions on use of property.
Yeah.
So that was kind of surprising to me.
If you try to flip a home in California and you're not a resident, they literally they won't let the title company give you your net proceeds from the flip until you filed the tax return, the estimated tax return with all the information on your flip and given California the estimated profit. Mm-hmm. I mean, they don't want to have to run you down out of state as a non-resident. Mm-hmm. If you're a non-resident flipping a house, they've got the title companies, because we flipped houses in California, mm-hmm. and we've had why are we filing a tax return? Well, we've got to fill out this information just for the flip. Mm-hmm. So we had to basically do the whole thing, how much we made. California, here's your piece, even mm-hmm. though it wasn't a huge piece, but it's a lot because their state taxes are mm-hmm. relatively high.
Right.
Okay, what else is going on with these states?
So these are states that have seen, California not so much, but a lot of these states have seen a population shift toward the positive. California not as much.
Okay, California actually had a net decline in 2020 for the first time in 90 years.
Right.
It was the first time in 90 years. But California is actually going through this phenomenon where some areas are growing still, mm-hmm. especially in the southern part of the state. The southern part of California is growing. The Bay Area and some of the coastal areas really aren't growing because they're not room to, but the inland areas, Riverside and San Diego County and stuff are growing.
Right, and Sacramento.
Sacramento area, of course, is growing too. Okay, so that's kind of an idea of where everything's happening. Now, you're probably saying, well, how is this important for home values and all this other stuff? So we've had this theory we've talked about where, first of all, we know 40% of all homes are owned cash. And then you have this huge other percent that have a substantial amount down. So there's very few people, probably 1 or 2%, that if something really bad happened would be forced to sell. Nobody's really forced to sell in this market. But the idea is, what about all these hedge funds and massive REITs that have bought? Mm-hmm. So we did some research and we found out that Blackstone actually had an event, or has had this thing recently, where people who invested in the REIT, mostly other funds, not individuals, are now coming back saying, hey, we need to get some cash, so we want to liquidate some of our holdings. But the REITs aren't, you can't just liquidate. Because what happens in most funds is when you want your money back, they have to go sell the shares they own mm-hmm. and liquidate it, and that causes the market to drop on those shares, right? Mm-hmm. Well, it doesn't work. You can't just sell the real estate, right? So I'm going to show the article. Blackstone chief defends real estate fund amid rush for withdrawals. So Juana, why is it very difficult for, say, Blackstone to just dump a bunch of houses and get money in a week to sell so they can give somebody their money back?
Because real estate is not a stock.
Yeah, you can't go on E-Trade.
No, you can't go on E-Trade and just dump it. So, and then not only that, but remember, they don't want to sell their portfolio when it's not a favorable time for them to sell. There's a cost to sell. We've all talked about this. I don't care if you're Blackstone or if you're an individual, there is a cost to sell. So then Blackstone has some choices. One of the choices is to say, so sorry, that's not going to happen right now. Another choice is to go ahead and maybe liquidate some houses. So for example, let's say that they own houses in 20 markets. So maybe they would sell 10 houses in each market, and that would give them sufficient liquidity to satisfy these people who would like their money. So that would be something that they could consider. Another thing that they could consider is, again, sectioning off some portion of their portfolio and selling that entire portion of the portfolio to another fund, and then getting cash that way to pay these investors.
Okay. I believe what they would do is they would sell their interest in the houses to another fund on paper, where they would still manage it, where they wouldn't change title. They would just literally go and say, here, we're going to sell our interest in this block of 1,000 homes that's producing X amount of dollars per month, and it's an ROI, and the state of Florida Teachers Retirement Fund or whatever buys that interest, and they just collect, they use their cash, put it there, and they just start collecting these returns, right? And then that way we don't see the houses being dumped on the market, because one of the problems is if they start dumping houses on the market, then it brings down the value of their whole portfolio. And they're very sensitive about that, because they are collecting rent, but selling a property is tough, because let's say you sell a property that you bought 2012. Now it's made a ton of money. Now you're selling it and paying taxes on it. But now you don't want to necessarily sell one that you just, like a single house that you just bought, because now you have to show in your fund that the fund is losing money. And you don't want to show that our fund, hey, we lost money on this asset, because you have less people want to invest in the fund in the future. Here's a quote from the article about the investors. In exchange for their patience, investors have benefit from a fund that Gray said has delivered 13% compounded returns for 6 years in a challenging environment. Now, the challenging environment is not the real estate market. It's the investment market. It's very difficult. 13% returns, it's very hard to get 13% returns compounded in over 6 years, right?
Yes.
Because the stock market is pretty volatile.
It is. And this is not a volatile market compared to a stock market. So this is why particularly funds and institutions want to invest with companies like BlackRock, because it is viewed as one of the safer investments. Okay.
Here's another quote from the article. Gray said the firm can sell assets to meet redemptions, but can do so over a time horizon that will be beneficial. So remember, they're going to act in their best interest. What is interesting is that they got this money very cheap to buy the houses, so there's not some liquidity event that likely would force them to sell either. It's actually better that they bought it than an owner-occupant in some ways, because an owner-occupant is, that's a risk. They lose their job or something else happens and they walk or they die, and then the house has to be sold. It comes on the market artificially early, or maybe not at the right time. This is something else that we've talked about. Talk to people about long-term investing, and because people always say, should I buy, should I sell, right? But the bottom line is you're stronger and in a better position when you get to choose the time when you liquidate an asset, right?
Absolutely. Absolutely. So I know we've talked about this a lot. You should buy when it makes sense for you to buy. You should sell when it makes sense for you to sell, regardless of what the market is doing, because your situation is so much more complex than just the one piece, which is the market.
It was kind of funny, because I remember doing a market update in 2012, back when we were told the shadow inventory was going to crash the market. And a lot of people were on YouTube saying the market was going to crash. And I was making videos at the time saying, no, we're not seeing that. We're actually seeing the opposite, because we're not seeing these other bank-owned homes getting ready to hit, because we would see them first, because that's what we were doing, is we were getting the listings from the bank and putting them in the MLS. we weren't seeing them coming. So people were saying they would crash the market. We're not seeing them. They don't really exist. Well, there were a lot of people that either sold or they didn't buy. And guess what happened? 2013 prices went up. And then 2014 they went up. So like people every ask was like, is it a good time to buy? Well, the only worst time to have bought would have been next year, right? Because every year it went up and up, and then it literally hasn't. This is the first significant price decline we've had, but it's only been for a few months, and it hasn't been that substantial nationally. We're still going to be up year over year. Some of the people have predicted year over year anywhere from 1% to 5%. Who knows, right? 2023, nobody knows, but those are aggregate numbers, right?
Right. So if you have a crystal ball you want to share with us, please feel free to send it to us. We will have it right here, and we'll look in the crystal ball and we'll let you know what it says regarding 2023.
Okay, this is the last quote for the article, then we'll wrap it up. We set up the product with limitations on liquidity, Gray told CNBC's David Faber during a live Squawk on the Street interview. We described it as a semi-liquid because we knew at some point there would be a period of volatility, and we didn't want to sell assets at the wrong time under pressure. So it's not a completely liquid. They have restrictions on how much they can pull out. Obviously the rents, they probably did the math and figured out, if they just did nothing but take the rents and to pay off people that wanted to get out of the investment, they could do that. The other thing too to keep in mind is that this fund that they've invested in has been buying houses for a decade. So there's a lot of base wealth built up into this because they have these houses not only that have been producing revenue, rent revenue for a decade, that they have substantial assets. So you're buying out of a fund that's backed by these houses that have a ton of, and I'm sure there are people who just need cash for something. Maybe they need to cover some other obligation or whatever.
Well, and I think, as far as the other funds that are invested in this particular fund, I think maybe they're seeing the uncertainty of the real estate market at the moment. And they're thinking that maybe they would like to reallocate a portion of those funds in a different sector. And that's natural, and I don't begrudge them that. These people that run these funds are far more sophisticated than we are, and they certainly knew when they got into this particular investment vehicle that they couldn't simply call up and say, "Hey, send me $1 billion back." That's not going to happen.
Okay, here's the good news. The good news is the investors can't crash these funds. These funds won't ever be forced to sell the houses. This is a huge stabilizing thing for the real estate market that a lot of analysts and pundits and people like that aren't taking into account. Because you have these houses that are literally permanently off the market. They're literally just going to be rentals. Because the idea that they just might say, hey, we're going to sell our whole thing off is highly unlikely. Because it'd be dumb for them to do that. The smart thing, even if they wanted to sell them all, they would be smart to say, look, we have this portfolio valued at X. We'll give it to you at a 5% discount.
Right.
And that's a lot of times how institutional investors sell their assets. They sell it at market value with a discount. So you basically take on, you pay the discount. If the discount's 5%, it's going to cost you way more than that in administration and selling costs. It's probably going to cost you 10% in your total costs, right?
An interesting thing for them to do would be to use the revenue from the rents as collateral to borrow money to pay some of these investors who want to get out.
Okay, so they take a loan, basically say, hey, look, we have this huge forward-looking revenue stream of rents. We want to borrow some money. We got to pay some of these guys off. Maybe there's something in there that says that if you want to be liquidated early, there's a penalty. You don't get paid at par. You get paid at some reduced amount.
And I think that's certainly a possibility. Like I said, these are very sophisticated people who have put this together, and I'm sure that there's something in there to that effect. Because if I can think of that, then certainly they've thought of far more interesting ways of dealing with it.
From our perspective, at least from my perspective, this is incredible in real estate from the perspective of solidifying the market from a the potential downside we would be seeing right now with interest rates would be much higher if not for this, I think. Okay. That if there were more human individual owners maybe trying to dump and sell their houses, but a lot of them aren't doing that because these hedge funds that just have bought in the last 10 years aren't selling anything. That's for one.
Well, and then remember, humans aren't selling right now because their interest rates are low and their rent revenue is high versus what their mortgage payments are and other debt obligations are.
Right. And if they bought 10 years ago, they're not selling because they're just going to wait it out. Like we've had a ton of people contact us and say, hey, this is what's going on. And most of them have said, you know what, we're just going to wait a year or 2 or 3 or, wait for this to just recover and chill out a bit before.
Yeah, I mean,
we want to pick our time to exit. That was not something that people had the ability to do back in 6, 7, and 8. They didn't have the ability to pick when they exited. They were being exited by the banks.
Right. I mean,
through foreclosure.
In the last couple of months, I've had multiple people with houses whose sexy number in the spring was somewhere around 5.25, 550, and they want the same thing now, which that's not happening, and they're like, you know what, we'll just wait it out, and they've gone ahead and put tenants in there, and they're going to wait it out the next 2-3 years and then come back to the market. So which is really interesting because they're not waiting it out for 6 months until the spring. They're going to wait it out for several years, and they've already determined that now.
Okay. Here's the long-term problem. So we talked about all the good things that have come from investors. We've been talking about this for a year, how the investors have been running up prices. They've been running up rents, which they have been. They've also made it more difficult for home prices to fall. Their prices have fallen, but not as much as people would have expected.
Right.
That's why a lot of the crashers have gone away because their predictions haven't come true. But here's the really interesting thing here. Potentially bad. The potential number of homes in the U.S. like 136 million or something, right? It's a huge number of homes that are in the U.S., right? But remember, you have a bunch of them locked up by investors never going to transact. So as that number continues to grow, because remember, every year when they acquire them, they're acquiring them at a rate that's about close to what's being built. So you have effectively the smaller pool of homes that are actually available to be purchased. And whenever that happens and that number narrows and you have a large group of people buying, it makes homes less affordable.
Right.
Which is a possible long-term thing that actually the builders not building and investors continuing to buy in the future makes it harder for just an average person to buy a house and more expensive.
Right. But, the flip side of that is market economics would say that, well, if that's the case, then builders will build more because they can get more for their homes. And that's a possibility too.
Yeah. But they can also build and potentially not because they're altruistic, but they will build because they see profit and say, hey, let's build well, if they're going to get $1 million for that house, let's build a house just like it and charge $1 million. It'll only cost us $600,000 to build. We'll put the difference in our pocket rather than let's build it and make $100,000, right? Let's just build it and take the profit, which they do there are communities they do that in, which are high-end communities that they know that they can make a lot of money because the demand, there's high demand and there's very little inventory.
Right. Yeah, I mean, look, these funds are a stabilizing force in the environment, but in the real estate environment, but they're also a force that impedes owner occupants.
Right, it does. We have seen reports that these funds are continuing to raise.
Yes,
they're continuing to raise funds to continue to do this.
And I wonder how much of that played into some of these investors who wanted some of their cash out, saying, "Hey, you're raising money, which means you've got money, so can I have some of it?"
Right.
So I wonder how much that played into it.
Well, it may not be this specific one because this specific one was Blackstone.
Right.
But it may be maybe they feel that if they take their money out of Blackstone, they can get a higher ROI with some other company, or they can go into the stock market or do some other thing.
Yeah, I don't know about the stock market, but okay.
Probably not put it in FTX.
Probably not.
Probably not FTX. Okay.
So tell us what you think. We are interested in finding out what you think. Please leave us comments. Please be nice to each other in the comments. Please subscribe, hit the notification bell, like the video, share the video, and we'll see you on the next video. Bye.
Bye.